let me start with Palantir. Let's just go Palantir first, and then we'll go from there. Okay, listen. Palantir today showed you how fragile this stock really is at this point in time. This news came out here today. Palantir and Anduril's battlefield communication system has issues, says the Army in a memo report. The modernization of the U.S. Army's battlefield communications network being undertaken by Anduril and Palantir, among others, has fundamental security issues and vulnerabilities and should be treated as very high risk, according to a report by Reuters. A September memo from the Army's Chief Technology Officer, that's a high-ranking individual, about NGC2 platform that connects soldiers, sensors, vehicles, and commanders with real-time data indicates some issues with internal product, according to the report. Quote, we cannot control who sees what, we cannot see what users are doing, and we cannot verify that the software itself is secure. Okay. As Army Chief Information Officer, Mr. Leo, publicly stated, the security review process during the experimental phase of NGC2 functionality as designed with findings mitigated immediately prior to field integration with first division level event, which proceeded successfully without delay, said a Palantir spokesperson. Palantir software, which maintains Impact Level 5 and 6 authorizations, provides the Army with visibility to rapidly conduct comprehensive security assessments across the NGC2 ecosystem. No vulnerabilities were found in the Palantir platform, says a Palantir spokesperson. The Department of War and Anduril did not immediately respond to request for comment. Where do we start here? Okay, listen. This is not a big deal for Palantir, and it is a big deal for Palantir at the same time, okay? At the end of the day, Palantir's business is absolutely booming, not just with the government side, but in many different government areas, and is also booming in the commercial space, right? And why was I buying Palantir stock at $6, $7, $8 years ago and loading up on shares? Because of the commercial opportunity, not because of anything military related. With that being said, here's why it is actually a big deal for Palantir stock. Palantir stock's valuation has gotten so insanely rich at this point in time that if you're talking about just a percent or two of revenue growth being, let's say, not there in the next quarters, the stock's going to get crushed. This is a stock that every single quarter has to show basically several percentage points of revenue growth acceleration, quarter in, quarter out. And as soon as people start to sniff out like revenue's about to start to decelerate, and let's say go from like a 50% revenue growth rate down to 45, the stock's going to get obliterated. And so what happens is you see on a day like today, just a little something in regards to Palantir and something negative, and the stock goes down huge, right? And obviously a 2x leverage against Palantir is up 15% today. That's the stage we're at this point in time in regards to Palantir. So if you get any other bad news or just a little worrisome here or there with regards to Palantir, the stock will continue to get hit. And think of it like this. When your valuation gets higher and higher, and when I say valuation, I'm not talking about your market cap. I'm talking about your P ratio and your forward P ratio. The higher and higher it gets, the more ridiculous it gets, right? Palantir trades at like a 300 forward P or something just ridiculous, okay? The higher and higher it gets, the more fragile you are, okay? So imagine like if Palantir today was trading at a forward P of 25, let's say, then imagine Palantir is like a piece of steel. It's like impossible to break that thing, right? Because you look at the growth rates and you say a forward P of 25 is like a joke, right? Like that's insane, right? Let's say they were trading at a forward P of 55 today. You say it's like a strong 2x4, right? Like that's going to be hard to break. It's possible, but it's hard to break because the growth rates are so strong. And then you have forward P, if you had a 50, 55 with the growth rates, it's actually not that high, right? Now, suddenly, let's say we take it up to a forward P of, let's say 100, 120. Now, suddenly Palantir becomes like a strong stick, right? Like from a tree, like a strong stick. Like, yeah, you can break it, but you're going to need to still take some effort. When you're trading at a forward P of like 300 or whatever Palantir's at right now, you suddenly turn into what? You turn into a glass. And all it takes is one little drop and your glass is shattered everywhere. That's what happens in the stock market when P ratios get way insane, okay? Then suddenly it's not hard to break you at all. It's very, very easy at that point in time. Okay. So as far as potential downside for Tesla and Palantir from here, here's what I posted on X here today, which my X is always linked in the description. I said, worst case scenario I see for Tesla and Palantir, if the NASDAQ goes down 10 to 15% this fall, which is nothing crazy, like that would just be a decent sized pull down, right? If that was to happen, Palantir, worst case scenario, goes 115. Tesla, worst case scenario, goes 325, in my opinion, right? Which is still a lot of downside from here, so do keep that in mind. But that's worst case. I said, if we have a 20% plus QQQ down move, right, which is unlikely, by the way, but that is possible. Like we did have that in 2018. I don't think this one's going to be as severe if we do get a pull down this fall, but if it was, you'll see Palantir go under 100 and you'll see Tesla go under 300. So do keep that in mind. But that's if you got that major pull down from here, right? So do keep that in mind. You know, in would I hold all the way to the lows as far as PLTZ or TSLZ? No, I'd be out of those way before that, right? I'm never, you know, with these hedges, I want to make a lot of money in a quick amount of time, but I'm not looking to like perfectly time it out at the bottom. Like if I can, whenever I get into a hedge, if you give me an opportunity to make 40, 50, 60, 70% in a quick amount of time, in let's say a month or a couple months, I'm taking that. Peace. I'm good. I don't need to make, you know, I make the crazy money on my long positions, right? Like early days when I was an investor in Tesla and Palantir and these sorts of companies, ELF, that make me 1,000% gains, 2,000% gains, 2,000+% gains. Those are where I make the game-changing money, the life-changing money, if we want to call it, right? Metastock. How much have I made on Metastock? What, 500% or something ridiculous, right? 7 figures plus on Meta. That's where I make the life-changing money, the portfolio-changing money is on long positions. Where I make that good in-between money is on hedges in time periods when the market gets way out of control. And that's certainly a time period we've been going through. It's been way too risk on for way too long now at this point in time, okay? Now that brings me up to 2018, right? Because I posted this inside the private stock group last night. I said, this whole year I've been talking about how many things remind me of 2018. In 2018, we had the last high on October 3rd. Today was October 3rd. Imagine how creepy it would be if the market starts going down next week and just keeps going down. Might not happen, but would be wild. So if you look at this, October 3rd here, right? The market actually closed somewhere around here roughly. So it reached a high intraday, and then we actually started to downtrend there, which is very intriguing because let's go ahead and let's take a peek at the S&P 500 on a 1 day. Are you kidding me? We reached the highs midday and then we finished much lower. Exactly what happened. This was a close on October 3rd. We fell off a cliff there, right? Came back a little bit, closed a little bit higher than where we were here. It's the exact same thing. It fell off a cliff, right? Came back a little bit, closed higher than here. The same. Creepy, man. That's all I'm saying. Like, it's just another thing on another thing. So we'll see. If this is 2018, the market will start downtrending next week. If the market doesn't start downtrending next week, then maybe it's not 2018, right? Maybe we can throw that out and say, hey, you know what? Maybe it's not 2018. But if this market starts downtrending next week, whoo, like, how are you going to say anything? You know what I mean? Like, that's just crazy. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Alrighty, next here, let's get more into this debate on AI, bubble, these sorts of
this subjects. Monday, NASDAQ's the winner. No surprise, because obviously what's happening in the tech and the chip space today more specifically. So stocks record high, Bitcoin record high, gold record high. Joe Edyardeni raises his price target back to 7,000. He'll be with us on Closing Bell today, so you can hear directly from him. He says the odds of another melt-up are at 30%, up from 25. He reduced his base case for a sustainable bull market, i.e. without a correction, to 50 from 55. So in other words, he's just more bullish. He's more bullish.
Hold on just a second. I was looking at the market here today, right? S&P 500 up 0.3%. Listen, ladies and gentlemen, just in regards to the market in general, I think the market actually looks really weak on a day like today. Seeing the S&P 500 only up 0.3%, you got to understand the only reason the market's up today is because of AMD. AMD, because the move is so outlandish here today, it's pushing up all the AI trade. It's pushing up all the, chip stocks, right? Everything in those are just all obviously massive market caps. If it was not for this AMD move here today, I think the market would be red today. I think it'd be a really weak day in the market. But when you got, arguably one of the most important stocks in the entire stock market, like AMD, up 25+%, it's going to push up everything. It's going to push up MU. It's going to push up NVIDIA. It's going to push up, the other semiconductor stocks, going to push up the whole AI trade, right? All the risk-on stocks like the Teslas and the Palantirs, they're going to move up on a day like that. It's just a huge, bullish momentum that happens. But to see the S&P only up 0.3% today, and I think the Dow's red, that smells like it's actually a weak market. It's just we got one company that's putting up a freakish day, and it's helping the whole market here today. So just something to keep in mind there. Don't say, this isn't a 2018 quite yet.
It's more bullish, and we're continuing to see the rally broaden out. Most recently, you have the Russell, which has broken out from a double top that it was traced out from 2021.
Yeah, but let's be clear. The Russell's moving up today because it's a massive risk-on day. One of the most important stocks in the whole stock market is up 25%. It's pushing up all the AI stocks, all the risk-on stocks. So the Russell's going up today mainly because of this one stock just put huge euphoria in the market today.
2024, so now that's participating as well. I've said the calendar is the enemy for those that are bearish because, in fact, you are going to see portfolio managers begin to chase. We're going to talk a little bit more about what Paul Tudor Jones said on the network today, but he summarized something that
could be, and where are you going to chase? If you're a fund manager, what stocks are you going to chase in this market, right? I'll tell you exactly who you're going to chase. You're going to chase AMD. It's got you're looking at AMD and you're like, oh my gosh, this stock's going to have so much bullish momentum for the next several years, but specifically over this next 6 to 12 months, as the numbers start to really accelerate and more and more investors start believing in the AMD story and what they got going on there and realizing, oh my gosh, this is actually a phenomenal opportunity, right? So if you're going to chase, I feel like fund managers are going to go to something like AMD, right? Big, proven, likely on the way to 250. Hop on now or miss the wave, right? And then we could talk about 300 or 400 being broken in AMD over time. So, yeah, if you need to chase to your end, you chase to AMD. That's the bottom line.
I am feeling, and that portfolio managers and financial advisors I speak with are feeling, and that is at the last leg of a bull market, generally that's where you get the strongest price appreciation. So you have to be there.
The so-called blow-off top? Is that what you're referring to?
You have to participate, but you also have those happy feet. You almost feel as though you're on your front foot, ready to sprint away from the market and have to be very tactical in doing so. And I think we all kind of collectively feel that way, but we're afraid to make that move ahead of the end of the calendar year because what's in front of us right now is a little bit unknown in terms of price. Okay. This could extend a lot further than we think.
You're talking as if everybody knows what you're referencing. It's Paul Tudor Jones who was on Squawk Box today, and he was asked about whether there's an AI bubble, similarities, rhymes, etc., to prior periods in history, especially obviously the late 90s. Let's listen to what he had to say, and we can kick it around on the other side.
Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
So let me push back against Paul Tudor Jones there, okay? Let's go to the compare feature here on 1000xstocks.com, okay? So who are the companies that are benefiting the most from AI? You know, at least in the short term, right? The companies that are viewed the most. Companies like AMD and NVIDIA obviously come to mind, right? AMD's just barely getting, you know, a little baby newborn in this market that's going to grow massively, right? So you look at it and you're like, oh man, you know, forward P, you know, high 50s, oh boy. Yeah, but they're about to absolutely completely change their entire business model on the financial front, revenue, profits, everything like that, right? So 59 is not expensive for AMD given the stage it's at. If they're trading at a 59 forward P 3 years from now or 5 years from now when the cycle's, you know, further along, then we might have a problem with AMD's valuation. But given this, they're just about to get to the show, like this is not a high valuation for AMD right now. 46 for NVIDIA, you know, a little high given the fact that they're already in the show, right? But remember, they're still going to report great growth. Like next year, expected revenue growth of 40%. Yeah, it's a huge deceleration from where they were growing, but still 40% is insanely strong, right? And so if they can grow revenue of 40% again next year, right, a 46 forward P is not high for that stock. Now, Palantir, Tesla, those are different stories. Obviously, those ones trade ridiculously rich, okay? So let's put Tesla and Palantir aside. Now, who are the other companies that are, you know, supposed to be benefiting massively from AI? They're Meta, they're Amazon, right? Companies like Google. So let's go ahead and let's pull up these stocks. So Meta's trading at a forward P of 24 with double-digit revenue growth and double-digit bottom line growth. That's not high. That's low. Ladies and gentlemen, that's low. If you grow in top line, bottom line, double-digit percentage, right? And you're trading at a 24 forward P with one of the best balance sheets in the world, income statements and cash flows, that's low. It's not high. Amazon is at a 32. That's historically low for Amazon on a forward P basis, by the way. And Amazon's growing double-digit top line, double-digit bottom line. That's not high. Now, is it as cheap as Meta? No, right? But that's still cheap. Google McDougal's at a 24 forward P, and they're growing double digits, top line, bottom line. Those are all cheap. They're not expensive, they're cheap. You say, okay, another beneficiary is Microsoft, right? Another company that should be a beneficiary is Salesforce. And then we can say a debatable one is Adobe, right? Some people view Adobe as they're actually going to be a big beneficiary of AI, and they say it's not going to be a big beneficiary of AI, right? But I think they'll be a beneficiary, but we'll see, right? Microsoft trades at a 35 forward P. You're talking about arguably the safest business model in the world, right? Recurring revenue streams, like countless business owners, business people like use their products on a day in, day out basis. Like it's just, you know, a must have for so many people out there. So 35 forward P with double digit top line, bottom line growth for arguably the safest business model in the world. Not high. You say it's not cheap, sure, but it's not high. CRM, Salesforce, trading at forward P under 30. You know, I think that's very fair for Salesforce, or cheap, depending upon what you think their growth rates are for the future. Adobe trading at forward P of under 20 with double-digit top line and bottom line growth. It's cheap. So, you know, I think stocks like Tesla and Palantir might give a bad rap to the whole AI trade, if we want to call it, right? Because those stocks have appreciated so much, their valuations have gotten kind of so ridiculous that, you know, they got forward P's at 300. So those two stocks, I think, are clouding the whole space. I think they're clouding the whole thing to make these Wall Streeters think like the whole thing's ridiculous. We're all going to come crashing down. The whole market has to crash. The market does not have to crash. Now, are we due for a nice size pullback either here in Q4 or in Q1? Absolutely. We're due for a pullback. But to say this is like, oh, we need to have the NASDAQ go down 80%, like massive crash, or 50% or no. What do you want, Meta? You want Meta to trade at a forward P of 12? A forward P of 12 with double-digit top line and bottom line growth? Oh, yeah, sure. I do too. We all do. That ain't happening. You want Google to trade at a forward P of 11? You go down by 50% or whatever with top line, bottom line growth of double digits? Sure, we all want that. I would love that too. It ain't happening. You know, would I like AMD to crash 50% and trade at a forward P of 25 when they're at the beginning of this new cycle? Sure, that'd be great. It ain't happening. You had your freak opportunity back in April with the whole tariff drama and all that. That was your one chance to get those stocks at ridiculously cheap prices, right? So to look at the market and be like, this whole thing just feels like 1999, we need to have a massive crash, blah, blah, blah. It's just not looking at the math. You're looking at your feelings. You're looking at your opinion. You're looking at Palantir and Tesla and thinking that's the whole stock market. So it all needs to crash because Palantir and Tesla are trading ridiculous. No. Just because Palantir and Tesla are trading at 4Ps of 300 does not mean Meta needs to crash and Google needs to crash and Microsoft needs to crash and Amazon. No, they don't. Would I love Amazon to crash 50% and be able to get Amazon at a 4P of 16? With double-digit top-line, bottom-line growth as far as I can see? Of course. Good luck. Good luck. Okay, so yeah, we're due for a pullback, but to say the market is 1999, we need a massive epic crash, it's just ridiculous. It's not looking at the math. And in the stock market, the thing that's more important than opinions, the thing that's more important than feelings is math. Math matters.
All right, that's Paul Tudor Jones. Always worth a listen anytime he is on this network. The idea is that you're afraid to miss out, so you keep running with it, but you got to get out quick because eventually it's going to end poorly. The challenge is being able to identify and get out quickly. Even if today it's going to end badly, you still don't want to miss out. As he references, we doubled in the NASDAQ from October 99 until everything ended in not too, late 2000.
Yeah. Let me be crystal clear about this. The best thing actually for the AI trade is all this worry about the AI trade. The fact that you got so many people worried and debating it, I don't know, these stocks might crash, they might crash. This is the best thing because that's what actually keeps the momentum going and keeps these stocks actually priced, reasonable. Outside of, once again, Palantir and Tesla, but the rest of the moves, that's what keeps these stocks actually reasonable and not going to some insane valuations. You can make an argument that AMD today should have been up 40 or 50% and not only 25%.
So you're really trying to pick that point in time when FOMO, the fear of missing out, turns into JOMO, the joy of missing out, when the market declines.
Do you think we're in the FOMO period now?
I do.
Have we really entered that yet?
Oh, I think we've been here for a while, but here's the difference between 90.
I don't think we've entered that outside of, once again, Palantir and Tesla. Please put those two stocks aside. Outside of those two, I do not think we're in a FOMO moment for the whole stock market. I just showed you the math. The math says all these stocks are actually undervalued right now or fairly valued, right? If you're in a FOMO market, all these stocks would be trading at ridiculous forward Ps, right? You'd have Meta trading at a 45 forward P right now, or Google trading at a 45 forward P, or Amazon trading at a 60 or 70 forward P, right? NVIDIA, you would see them trading at a forward P of like 100, right? Given the growth rates they have. And then you say, oh boy, if that slows big time, that forward P of 100 ain't going to last. That would make me say, you know what? Yeah, we're in a FOMO market. But how can I say we're in a FOMO market when we got stocks like Meta and Google trading at forward Ps, in the low to mid 20s? I can't say that, right? There's no way.
I think it's going to end the same way. But the reason why this will extend longer than that October to March period that he's referencing is that you can go into business just by hanging a sign out and taking advantage of the internet. And it really didn't take much capital to do that. Here, you actually need capital to play, and you need real engineering talent, which is human capital. So sure, you've got some small companies in the private markets that just aren't going to have any business model ever. But when we're talking about the larger companies in the private markets, they're real assets. So what you're talking about is not sustainability of the business model, but valuation of the business model. So there'll be plenty that go bankrupt and belly up, as I said, but overall, I just don't see the bubble bursting while you still have this major spending cycle.
Well, that's the thing.
CapEx going on.
That's the thing. It's as long as the CapEx music is playing, so to speak, people are going to continue to dance to it. Yeah. And there's no indication at this point that it's going to stop anytime soon. And many notes are talking about the fact that, look, CapEx is good.
Okay, let's take it to the most, sometimes in the stock market, it's best to take it to the most insane situation, okay? Let's say Meta, Google, Amazon, these companies, right? They all stop this crazy CapEx spending, right? They're all like, we're not going to buy nearly as many NVIDIA chips. We're not going to buy nearly as many AMD chips, right? That would suck for AMD and NVIDIA stock. Wouldn't that suck for Meta, Google, Amazon, et cetera, et cetera? No. Then you can say, well, now they're going to take all that extra money. They're going to spend $50 billion on chips, blah, blah, blah this year, right? And infrastructure for AI-related stuff. And they're not going to spend that now. So what are they going to do with that money? Probably massive share buybacks, which then increases their earnings per share massively because their net income keeps going up. So you bring down the share count a ton, your earnings per share explodes even higher at even a faster clip. That's the worst case scenario. That's completely ridiculous and completely unrealistic. But that's the worst case scenario. If anything, you could say maybe Meta and Google would probably go up in that situation, right? Because then they'd turn into a massive buyer of their own stock. Sometimes playing out the worst case scenario, you realize it's not as scary as it seems.
Going to remain robust, and then that's still going to be the thing that carries it. Wells Fargo today, don't underestimate the CapEx cycle. Expect it to continue. Eric Sheridan, he's the tech analyst at Goldman Sachs today on the question of a bubble. We see some reasons to reference the late 90s, but don't yet see all the alignment for a market dynamic that would result in a dramatic and negative re-rating. That seems to be the prevailing view. What about you?
That's right, Scott. I think the key word in there is yet. So we have to think about the CapEx announcements that we're getting in terms of the demand growth that we're expecting. And if we look at data centers, for example, today, there's something like 82 gigawatts of data center capacity demand, and that's projected to go to 119 over the next several years. So all the announcements that you're getting are in order for us to get to that build out of data centers. But at some point, we will have built enough data center capacity, and the question is going to be, is the demand is actually there? So to me, one of the key points as we go through this earnings season is I think what investors are going to start questioning again, Scott, which is are there signs of AI monetization? Do we actually have companies that have killer apps that are generating revenues from those? Do we have tangible savings from infusing AI into companies? And, I think we are seeing some of those signs for some of our portfolio companies, and we certainly focused on that. But I think the market will focus on the larger ecosystem. And I don't know if there are that many signs yet to point out to the monetization. So I do wonder if investors will start to question the trajectory of the AI CapEx trend near term.
Not until, somebody warns about it or raises some flags about it, in earnings or otherwise. Greg Brockman, OpenAI, he told Carl and Jim earlier, quote, "We need as much computing power as we can get." Lisa Su of AMD, AI compute is needed everywhere. So everybody's talking the same game, that there's just not enough compute. You're not going to need less, you're going to need more, and you have to spend. You'd rather err on the side of spending too much than too little, because that's the environment that you're in. There is these, so-called circular deals, vendor-financed deals, so to speak, that makes people a little bit nervous. But like I said, companies are making it awfully clear. They're saying it publicly, and I'm sure privately, they're just going to spend, and they're going to err on that side for now.
Scott, we're relying a lot on OpenAI, aren't we, in that spending? And we're relying on OpenAI to spend trillions of dollars. And I think the question becomes, where's this capital coming from? You can make the argument it's coming from venture capital, debt markets, some unique type of financing.
Yeah, they keep raising money. They're at a $500 billion valuation in the private market.
And I've said I think they're headed towards $1 trillion when they ultimately IPO. But this spending that we seem reliant on from OpenAI, obviously it benefits NVIDIA. You asked at the top of the show, what does the deal with AMD mean? Not very much. NVIDIA is down 40 basis points on the day.
It's barely down.